So the Fed does not want to reduce interest rates. Meanwhile, in Europe, the ECB has reduced interest rates all the way down to 2%. What's the difference between the Fed and what's going on in Europe? Well, quite simple. The Fed itself sees inflation as sticky, even though inflation is dropping and getting towards the target of what the Fed sees. It is concerned that if it reduces interest rates, then that is going to cause a spike in inflation, especially under the trade war scenario. And they really are reluctant to reduce interest rates in the US. However, in Europe, they've done the opposite. What they've done is they've reduced interest rates and they're looking to stimulate the economy. Well, if you look at the US, you've got a very healthy non-farm payroll job number, you've got increasing production, you've got consumer confidence, which is higher than expected under the circumstances. So when the Fed is looking at these numbers, it's thinking to itself, hold on, the economy is not so bad under Trump. Even with the trade war, it's got a balance of trade that's actually more healthy than it's been for years. And what they're concerned with now, that if they were to reduce interest rates, then they will end up fueling inflation. However, as long as those interest rates stay high in the US, you're going to have the high risk of a property crash. In the US already, there are 2 sellers for every 1 buyer. And that is not a good sign for those people who are trying to get onto the property ladder and those people who are trying to sell their properties. Interest rates are far too high in the US. Interest rates need to come down to around about the 3%, 2.5% level to stimulate the real estate sector. In the UK, there's going to be a property crash, quite simple, because they've got no growth, they've got rising unemployment, and they've got rising public spending, with bond yields going extremely high. Bond yields is an indication as to where interest rates or real interest rates are going to be over the period of time. And if you look at bond yields in the US, in the UK, in Japan, in Germany, across the board, even in Australia, you'll see that on a trajectory going up, not going down. So therefore, you can expect real interest rates to remain high over the coming months and the next year and a half. That would put pressure on the property market. I expect properties to fall around about 25% starting end of the year into 2026. If you're interested in following my trades on stocks and shares, then DM the word stocks and we'll get you on board. Catch you later.